Let's finish up talking about student loans by talking about how much you can borrow and the interest rates related to what you borrow. Um, let's um, let's first talk about for your undergraduate education. And I guess really that's all we really need to talk about. Remember, I said there was a loan program called Perkins loans, but those have expired. So I'm just going to talk about the direct loans. So for direct loans, and this changes from time to time, but it's about 5,500 to 12,500 per year. And when you're a graduate student, so we won't waste our time talking about that here, but when you're a graduate student, those numbers go up a little bit. Now, the real question is how much should you borrow? And again, I made just about every financial mistake I could when I was younger. And one of those was borrowing more in student loans than I really needed to. And so remember, when you get your loan offer, it's going to give you a lot of information. So they're going to estimate what your living expenses will be. And that's based on that cost of attendance that the institution that you're considering will give you. And so you can turn down a loan or take less than what they're offering if you feel like what they're saying it's going to cost you is too high, that you can live a little cheaper than what they're estimating. So the important thing is to borrow only what you need. Because also, remember we talked about the difference between subsidized loans and unsubsidized loans. So they're going to show those unsubsidized loans on your offer and you don't have to take them. So borrow only what you need because it's a good idea for you to calculate your own estimate of what you need and not just rely on what you're going to get back in your financial aid offer. But still, you want to keep a little cushion for unexpected things that might come up. Now, one rule of thumb that is really pretty practical is don't take out more in student loans than what you expect for your first year's salary to be in your field. So, for example, if you're planning to go into a field where you're going to start out making $20,000 a year, you shouldn't be taking out $40,000 a year in student loans. It just doesn't really make sense. Because you're going to have to pay that back even if you can't find work in your field or the work doesn't pay very much or you kind of just misjudged whether or not that was what you wanted to go into. Once you agree to take that money, it's your responsibility to pay it back. So make sure that you look at the terms and conditions of any loans that you're offered, like the interest rates and when you're going to have to start repaying them. Because remember, we said if you take out a private loan, you might have to start repayment before you finish taking classes. So now, speaking then of interest rates, what's that about? Let's talk about how interest rates work. Because one thing that we've already mentioned a little bit is that the lower the interest rate, the better, because that's going to lower how much your payments are going to be. So you may have already talked about interest rates in your math classes. And so we're not going to go into that level of detail, but you do need to know how interest rates affect your loan before you borrow. So interest is the money that's paid to the lender at that particular rate or interest rate in exchange for borrowing a certain sum of money. So that's basically, how the lender makes money. So interest rate is calculated as a percentage of your unpaid loan amount or the principal. And you're responsible for paying interest on those unsubsidized loans. Don't forget that. So a subsidized loan means the government is paying the interest. An unsubsidized loan means that you're paying the interest, or at least the interest is accruing or being added to your loan balance. So on a federal loan, interest rates are going to be fixed, remember? And so let's see, if it is a direct subsidized loan, those have the lowest interest rates, which right now are about 4%. And then if it is direct unsubsidized, those are next. And that's about 5%. And then a direct plus is going to be about 6%. And that's what it is right now, just to give you a sense for what these loans might be, where loan interest rates might be. And then a private just depends on the lender. So it could be fixed, it could be variable, which means even that rate could change. So the last thing that I want to talk about is, how do you pay these loans back and when? So with federal loans, you have different options. And for the private loans, that just depends on what the terms are of that loan. Remember, that's all, it's not regulated by the government, and it's all just what you negotiate with your bank. But let's talk about repayment on federal loans. So there are different options. We have standard. And so the standard repayment is 10 years. Then there's graduated. And on a graduated loan, you start off small, and then you go up every 2 years. Then there's extended. And this is another way to keep your loan payment small, but you pay it off over 25 years instead of 10. And then income-based. If you're expecting your income to increase over time, then you may decide that you want an income-based loan where your payment depends on your income. And so it's usually capped at 10% of your discretionary income, not total, but what you have left after you pay, rent or mortgage or whatever other key expenses you have. But in fact, they don't ask you that. It's just based on certain guidelines to determine what your discretionary, what portion of your income should be discretionary. But the bottom line is it will increase as your income increases. Similarly, there's income contingent repayment. And that could be either 20%, so it's similar to this one, but it's a little bit higher, 20%, or whatever the payment needs to be to pay it off in 12 years. So lots of different options. The idea is that the standard is paying it off over 10 years, but when you get to repayment, if you find that that's too high, you have some other choices instead of just being strapped for cash or not being able to make the payments and getting into trouble with the federal government. So lots of things to think about, and these are all very important things to know before you get your student loan. So we've covered everything that you really need to know at this point about student loans so that when you get to that point, you can make an informed decision.